The U.S. government is still shut down. We may be approaching a debt default, and there are concerns over third quarter earnings. You're in the right place, folks, because this is where the money is. Welcome to the show. I'm Matt Copenheffer, and this is David Doomsayer Hansen. David, can we find good news anywhere?
That was the most depressing opening I've ever heard in my life.
So depressing. It was so depressing. Well, here's something that's not depressing. You were seeing the future, apparently. Did you watch Saturday Night Live over the weekend?
I did not, no.
If you recall, on Friday, I asked you about Miley Cyrus and what advice you'd give to her. You said to just embrace it and go with it. Mm-hmm. I watched some of her performance on Saturday Night Live. She appears to be doing exactly that.
She's embracing it?
So she is, apparently Miley Cyrus, maybe a big fan of this show, heard your advice, and is going for it.
That makes sense.
Hopefully she heard mine too.
One of our half dozens of listeners out there.
Maybe she's investing in low-cost index funds.
Let's hope.
As well. All right, let's get to the show, depressing as it may be. Let's see if we can find a glimmer of hope in here. First headline is from Bloomberg. The headline is a U.S. default seen as catastrophe dwarfing Lehman's fall. Yuck. From the article, among the dozens of money managers, economists, bankers, traders, and former government officials interviewed for this story, few view a U.S. default as anything but a financial apocalypse. So, from my perspective, I'm not sure that I'm totally on the apocalypse bandwagon. Now, on the one hand, part of the problem is that there are so many covenants and legal things set up there that if that word default ends up being applied to U.S. obligations, that will cause a cascade of problems that will be pretty dire, legitimately dire for the U.S. financial system. On the other hand, again, it would be more like a technical default because we've got circus clowns, as I continue to call them in Congress, would be refusing to pay the bills, as opposed to an inability to actually meet the obligations. So there is a difference there, but it's questionable how much of a difference that's going to make once that default label is put on it.
I'm with you. I don't think this is as clear-cut as, okay, we have a default, the world is ending 10 times worse than Lehman. Yeah. I don't think that's the case. When we look back,
it's not going to be good.
Right, it's certainly not good news, but the problem with Lehman was there were so many assets out there that people just did not know what the value was, what the underlying value of the assets were. I don't think that's the case with U.S. Treasuries. I think people can still say, here's the underlying value, I know what it's worth in the long run. And to give you some numbers, if we look at the CDS market, I know that's kind of a scary place to some people, so credit default swaps, basically insurance against U.S. Treasuries. There's about $3.4 billion of outstanding CDS. $3.4 billion, that sounds like a big number, but the total CDS market is $25 trillion. Mm-hmm. So CDS against U.S. Treasuries is up around 6% this month from last month. So it's up, but it's still such a tiny sliver of the market. I don't think anyone out there really expects the U.S. to default on their debt.
Well, yeah, the expectations are. In terms of the companies that we tend to talk about, banks would certainly get hammered. I think a group that I may be even more concerned about are the mortgage REITs, and in particular those dealing with agency securities. It's kind of a situation where if we end up in default, do you really worry about one group of companies more than the other? I mean, maybe not if everything's going to be dropping. But I would be concerned about the mortgage REITs. I would be particularly concerned about the ones that are more leveraged than the others, just because that leverage will cut very, very badly in a default situation. American Capital Agency levered it almost 10 times, between 9 and 10 times. Armor Residential at about 11 times. This is assets to equity. Annaly down at less than 8 times leverage. And this isn't quite a fair comparison because Two Harbors is a combo REIT. They invest in a whole bunch of different stuff. But since I like Two Harbors so much, got to bring them up just over 5 times leverage. So that would be something to look out for, but I feel like everything would be falling. We just want to avoid that default situation.
I agree. All right, let's move over to the next headline. Got some good news with this one from the Wall Street Journal. Buffett's crisis lending haul reaches $10 billion. We saw the Mars investment pay off, the Goldman Sachs investment pay off. Matt, I
still like the Mars.
Yeah, the Mars investment was good. Do you just look at
interplanetary Buffett?
Do you look at Buffett and Berkshire Hathaway and just say, I have complete faith? I know you're a shareholder. Do you say I have complete faith in this company?
Well, I hate to rain on the parade here, but I should just point this out. Buffett's and Berkshire has made about $10 billion on these crisis-era bets, but that's on shareholder equity of $205 billion. So it's kind of a little bit of a drop in the bucket from those investments. But I mean, those are just a few investments. So on the one hand, we could say this is yet another example of Warren Buffett actually executing on the wisdom that he puts out there. And he says, be greedy when others are fearful, and fearful when others are greedy. Clearly, he was greedy when others were fearful. This paid off. But this also shows the importance of the other parts of Berkshire, and particularly the operating businesses. The investments are great, but there's a big railroad in there. There's the insurance operations, so there's a lot more to Berkshire than just that. So the $10 billion, nice, but not incredible.
When you look at the stock today, I think it's trading maybe at 1.4 times book. Doesn't seem overly expensive. It's not at Buffett's threshold where he's buying back his own stock. Do you kind of see it as a hold right now, or is this a stock that you could potentially be interested in adding more to?
I think it's a reasonable buy. If you don't have other ideas that you're really excited about, I think this is a good buy here.
Nice.
Third headline, this is from CNBC. Corporate profit outlook is weak and getting weaker. This is about the third quarter. We're just entering into third quarter earnings season. CNBC right there to punch it in the face. Part of my problem with this is that when we talk about quarterly earnings from a big picture perspective, it's a little bit tricky because there are a lot of moving parts, and some of them may not mean what. When you put it all together, it may not be the same picture that we think it is. So let me, because I'm not being very clear about that, let me put some more specifics on it. Financial sector earnings, for instance, this quarter are likely to be down. Part of that is from fixed income trading. Part of that is from mortgage fees because the refi bubble has popped. So is this a good or bad thing? Well, with the fixed income trading, it's bad, but it's sort of short-term and cyclical. From the mortgage fees thing, this is a higher interest rates have ratcheted down refinancing. That I think is a mixed bag. Lower fees, not so good, but higher interest rates could be good longer term. So if financials are pulling back the overall growth rate for the quarter, and everybody's looking at the overall growth rate for the quarter and saying, oh, this is bad, then you're getting sort of a misleading read on where corporate America is.
Right, I agree. And the article points out, says balance sheet strength is going to be called into question. I don't agree with that. You look at balance sheet strength today, it's very, very strong across the board. You look at banks, they're being flooded with deposits. Corporations are just rich with cash right now. I don't think balance sheet strength should be a question at all.
There are a lot of balance sheets that are too strong out there,
right,
and that the companies could create value by giving some money back to shareholders.
All right, moving on to our next round, looking at a couple more headlines, rapid fire style from American Banker. Very simple headline here. PNC cuts mortgage jobs. Joins the pack. Wells Fargo, Bank of America, all of them cutting mortgage jobs. PNC, it's interesting there. They don't focus too much on refi. They want to give actual purchase money, mortgages out there to their clients and their customers. So I think they came out and just said, hey, this is a cyclical business. We're scaling back as we need to. I don't think this is a concern for PNC.
Okay. Bloomberg, Treasuries be calmed. Be calmed. Wow.
Is that a word? Treasuries
be calmed as debt cap approaches with gross buying. And that's not disgusting buying. That's Bill Gross of PIMCO. This is essentially saying what you just said earlier, is that there is still a lot of confidence in the U.S. Treasury market. The quote-unquote smart investors, or the smart money, as you might say, getting in there and buying over at BlackRock. Larry Fink talking about buying Treasuries, and then Bill Gross over at PIMCO, considered the bond king. Some questions over whatever, but he's buying as well. So you've got the smart money going towards Treasuries. So maybe that's a good sign. I don't know.
All right, next thing I was looking at, not a headline, so I'm kind of cheating here a little bit, but Fannie Mae released their September survey of households. They basically go out, ask all these people, hey, how are you feeling about the housing market? How do you feel about this? How do you feel about that? A couple things that stood out to me.
How do you feel about Miley Cyrus? Is that one of the
questions?
questions?
That was one of the questions,
okay.
Actually. It's trending higher.
How do you feel about twerking?
A couple things that stood out to me were the average expectation for home price increase, if that makes sense at all. So how much do people think their house is going to increase over the next 12 months? The average was 3.1%, and that's actually lower than the previous 3 months. So maybe not going in the right direction, but still pretty healthy there. But 62% of people that responded to the survey thought it was a good time to buy a house. That's actually higher than September of last year. Might be surprising to some people. The housing market has been a little bit slowing recently, I guess you could say, but people are still think it's a good buy, even though prices are up 10% over the last year. So maybe there's still some optimism out there.
Nice. And the final headline from the Financial Times, $32 billion hedge fund D.E. Shaw shuts doors to new investors. Essentially, the company is closing off its funds to new investors, trying to protect returns, wants to be able to give its current investors the maximum amount of returns. This has been a phenomenally successful hedge fund family. One of the things that this made me think about was the constant push and pull that we're going to have to deal with, or that investors in the publicly traded PE hedge fund groups are going to have to deal with. So Blackstone, KKR, Apollo, these companies, the idea of bigger profits for the public market investors are going to be a lot fixed to how much new funds, how big the funds are that these folks are managing. And yet at the same time, we know that bigger funds, the bigger a fund gets, the more difficult it becomes to get outstanding returns. Right. So it's going to be an interesting thing to see how they manage that over time. So I'll be keeping an eye on that. Moving on to our focus for today, and it is Monday, so we're going to be looking ahead to the rest of the week. What do you have your eye on, David?
Got to go all the way to Friday. Earnings season
starting
kicking
with
off.
Friday.
Starting with Friday.
It's Monday. Come on.
Alcoa no longer kicking off earnings season for the Dow. That honor now belongs to JP Morgan.
Still kicking off earnings season.
Still kicking off the season, but not for the Dow. Not for the Dow. That's JP Morgan's job now. They report on Friday. Wells Fargo reports on Friday. Really going to set the tone for what the big four banks are going to look like this earnings season. Also probably some of the regional banks to some extent when you look at mortgage lending and just business lending across the board there. For Wells Fargo, 14 consecutive earnings of record profits there. So 14 times they've topped it. Pretty impressive run that may come to an end
it's
this
ending.
corner.
It's
okay.
ending.
I was trying to be a little bit optimistic.
There's no reason to be optimistic or pessimistic about it. It's just being realistic about
it.
So
it stinks for Wells Fargo. They can't print 15 consecutive quarters, but I don't.
So sorry. I'm playing the smallest violin in the world for Wells Fargo.
Still making probably $5 billion for the quarter. So I don't think it's a big concern for Wells Fargo. This is a bank that's still very well run. It's still going to make $20 billion in profits probably over the next year. So yes, they don't have the record anymore. Mortgage banking will probably be lower, but this is still a bank that's going to perform well.
JP Morgan, any thoughts there?
What are your thoughts on JP Morgan? I'll kick it over to you.
Well, the bank is going to face a lot of the same things that Wells Fargo is on the mortgage side, because it's the number 2 mortgage originator behind Wells Fargo. But there's also going to be the hit from fixed income trading, which Wells Fargo isn't going to see as much of. It's been a terrible quarter for fixed income trading. That's no secret. We've heard that from Jefferies. We've heard that out of Deutsche Bank. I don't know that there's going to be a way for any individual. Maybe some of the individual banks have sidestepped it, but it's really a matter of activity. So I don't think you're going to see drastically different activity levels at any given bank. So you're going to see that JP Morgan. And then also, I guess we're not going to see we're probably not going to see that legal hit, right? Because they haven't come to an agreement on the monster settlement. So
I suppose when they release their 10Q later, they may amend that section where it says how much we expect to pay. So that's where you'd see it.
Oh, yeah. Good point. So JP Morgan, probably similar to Wells Fargo, probably a little bit worse. Of course, we'll be watching the government shutdown and the debt ceiling debate this week. We have to mention that. Alcoa will report earnings tomorrow. I don't want to leave Alcoa behind. They got unceremoniously kicked out of the Dow, but still the first to kind of kick off the earnings season. It's not really the bellwether that it used to be, but I still think that it's not unreasonable to take a peek at what Alcoa is doing, because the demand that they're seeing, at least, maybe not the overall results that the company shows, but the demand that the company is seeing, because that is a key input to a lot of different industries.
Right.
It could be interesting to watch. On banking, on Thursday actually, Bank of the Ozarks is at least slated to report. Sometimes early on in earnings seasons, the schedule isn't exactly on point. But this would be an interesting one for investors to tune into as well, because as opposed to JP Morgan and Wells Fargo, this is a much smaller bank, about $4 billion in assets, but a very, very successful bank. It's been churning out about 2% on its assets and about 16% return on equity. So I'll be interested to see what a really quality smaller bank is doing in this environment. And finally, on Wednesday, we've got the FOMC. You knew I had to mention it. Come on.
I'm sure they're going to make. They haven't been in the news for the past couple of weeks. So I'm sure they're going to make some big stink about the FOMC minutes. So
of course,
I'm not looking forward to it.
Well, look, here's the other thing, and here's what you have to look forward to: is that the longer this debate over the government shutdown and the debt ceiling goes on, the more that the Fed is going to have to step in, because I mean this is having and is going to have real economic impacts.
I think these last couple of weeks just show how quickly the news cycle moves in terms of what's the most important thing. Sure. A couple of weeks ago, everyone's saying, "Gotta watch the Fed. It's all about
taper.
the Fed."
It's all about the taper.
Fears over intervention in Syria. We're not even. That's nowhere on the headlines now. Now we have the government shutdown, the debt ceiling. All of this stuff is so short-lived.
Well, to be fair to the media outlets, when we're looking down the barrel of defaulting on our debt, I think it's reasonable that takes over the news wires.
So.
All right, our game for today, making the grade. We've got 3 different scenarios here, and for each scenario, we're going to draw a picture to illustrate our thoughts on that scenario.
Okay.
So David, why don't you tell us what the first one of these scenarios is?
The first scenario we're looking at today is about PayPal, a subsidiary of eBay. That's the publicly traded company that it's under. They are trying out free 2-day shipping with, I think, 9 merchants out there. Maybe a little threat to Amazon. What is your grade for this experiment?
I need your pen.
Need a pen?
I don't have
Go
a
for
pen.
it.
I see. Here's the thing: is that I don't think that it's just a Amazon issue here. In fact, it's funny that you mentioned Amazon, because I wasn't really even thinking of Amazon when I saw this. Mm-hmm. I was thinking of Visa and MasterCard. And here's my grade. That's Visa and MasterCard down there. That is a guy who's very scared.
Okay.
That is a guy that's worried. And the issue here is I think Visa and MasterCard, great companies, and plastic in that mode and method of payment has become so ingrained that I think we can rely on that being the kind of the de facto payment method, mm-hmm. or the growth, where the growth is going to be in payments for some time to come. But PayPal is getting aggressive and has been aggressive in how it's growing its business. And when we think about the prevalence of cell phones, smartphones worldwide, if PayPal is pushing out the ability to pay at stores through that, mm-hmm. get people more used to using their PayPal accounts, going online and doing it, and I see this 2-day shipping thing as part of that, I think that's a concern for Visa and MasterCard longer term. All
right, I'm gonna echo some of those thoughts and give it an A. This is also a little concerned, man. It's Jeff Bezos, but he's a little concerned, not a big concern.
Why is Jeff Bezos concerned?
2-day shipping, free shipping, that's their trademark there over the Prime. So a little concerned, not huge. I do agree that Visa and MasterCard should be a little bit concerned, because when you're doing online shopping, a lot of people don't think to do PayPal. It's kind of oh, maybe I have a PayPal, but mm-hmm. if they can get this in people's minds, like you were saying, it could really be something.
But I don't know the partners that they're working with on this. I mean,
there's some big ones out there. Dick's Sporting Goods, that's a big one. But I think
getting some new golf clubs.
I think when you look at PayPal, they just made recent acquisition. They're now doing this. I just think I will be incredibly surprised if PayPal is not a standalone company in the next 5 years. That's my.
You think eBay is going to spin off PayPal?
I think eventually they will. They just
think somebody tries to acquire PayPal after they get spun off?
Potentially, we'll see. But that's my prediction. 5 years. They'll be standalone.
All right, let's get that next scenario up there. The next scenario is banks adding branches. Actually, let me give this back to you. Banks adding branches. So we've seen over the past few years, mm-hmm. Bank of America is a great example of a bank that's been cutting branches, cutting operations. But we've got a bunch of different banks. I think you were mentioning to me Huntington Bank Shares is mm-hmm. an example. What were the other examples?
BB&T.
BB&T adding branches. Mm-hmm. So what do you think about the banks actually adding branches as opposed to cutting?
I'm going to give it A traditional C minus. I'm going to keep it easy here.
That's pretty vanilla.
Well, there's people listening on the
All
podcast.
right.
They can't see my.
There are people listening on the podcast.
C minus.
Good plug for the podcast. by the way.
You look at Huntington and their CEO. He's done this before. He's built a bank by building out a great retail footprint. So part of me wants to say, yeah, you increase your branches 6% year over year. That looks good, but I just don't know if the future of banking is going to make sense with a big brick and mortar footprint. When you look at Bank of Internet, you look at Bank of America trying to scale back their branches, I just think that makes sense from a cost structure. So C minus, maybe there's hope for it, but I'm not super hopeful. What do you say?
I say I've got this little guy here riding an arrow up and to the right. Up and to the right means growth, and he's saying wee. Look, with Bank of America, I think what we could compare it to is if we think about maybe a retail or a restaurant group that's overexpanded and has operations in a lot of different parts of the country, but maybe has gotten a little too aggressive about it. Starbucks actually comes to mind. Starbucks went back through a couple of years ago and was actually closing down some of its stores because it had gotten a little oversaturated. And I think maybe that's a little bit of what happened to Bank of America. They've got a great nationwide presence, but maybe don't need all of those branches. Meanwhile, Huntington and BB&T and some of these smaller regional banks, they can get in there and still make hay by getting brick and mortar branches in new geographic regions.
We'll see. All right, the next scenario, we've got our final scenario of the day. It's about Wells Fargo. So grade Wells Fargo's acquisition of Wachovia.
I can already see your...
I've already started here. All right, so I'll go first. Grading the Wachovia acquisition, and there's my grade. For those of you just listening, it is an extremely muscular man flexing and smiling wearing a Wells Fargo hat.
I think you need some anatomy lessons. That guy's got like muscles where there are...
It's a rough drawing. So the acquisition of Wachovia, I think this was a home run for Wells Fargo. When you look back before the acquisition, I think in 2006, I want to say, their deposits were under $300 billion. So under $300 billion in deposits. Today, it's almost at $1 trillion. And this acquisition, it did bring over some problems. Wachovia had acquired Golden West that had some mortgage issues. But you just look at the footprint that this established. Wells Fargo, very concentrated in the middle of the country, West Coast, basically had no exposure to the East Coast, got all of that with the acquisition of Wachovia. When you compare it to the acquisitions of Merrill Lynch, et cetera, they're stronger for this, and they're happy today.
For the benefit of the podcast listeners, I just also have to point out that he's also wearing a Heisenberg hat. Here's my grade. I'm just going to keep it simple. What he said, I cannot top the weirdly muscular man with the Heisenberg hat. I think it was a good acquisition as well.
All right, moving on to the last segment of the day on the Twitter sphere. Our first tweet of the day is from Crowd Turtle, one of my favorites. He says, "A true crisis finds a way to kill the banks." Matt, when you think about this crisis, quotations crisis, that we're potentially moving into, is this a bank killer at all? Maybe?
You're talking about if we default?
Sure.
Potentially. It would certainly kill some. I think there's, if this happened, we would see many banks go under.
If we default on our...
Yeah.
I'm going to disagree.
Okay, go ahead.
Okay,
feel free.
I'm rooting for a default.
I'll be right.
All right.
This
We'll
will.
Next tweet?
You are dead wrong on that. Next tweet. This is from Money in Stereo. That's at money_in_stereo. Fair Home opens hedge fund to institutional investors. What do you think of this move? Fair Home has been a very successful fund, and in particular has been known over the last few years for the giant positions that Bruce Berkowitz has taken in financial companies.
I don't think they're going to have trouble finding people to invest in this. I mean, he's earned the reputation of getting into these situations, and everyone goes, what is he doing? Why would you invest in AIG and Bank of America? Why would you put money behind Fannie Mae? I know that's something that we question.
Yeah, sure.
He does own mostly preferreds, not the common, so he has a little bit of maybe a better chance there of making that investment turn out for him. But I think he's earned it. I mean, you look at the performance track record, I don't think they're going to have a hard time finding.
I think the approach lends itself better to hedge fund type investors because it's so concentrated and sort of swing for the fences, I guess.
Right. All right, final tweet of the day. It's from our own Joe Mager. He says, a shame most dudes spend more time thinking about their fantasy football rosters than they do their portfolios. Do you?
Untrue. Well, I have to say,
most dudes, you said. You didn't say you.
I spend a decent amount of time thinking about my fantasy football roster. However, we spend a lot of time thinking about our portfolios and thinking about the overlap actually between fantasy football and investing. And earlier this year, we had
the fantasy stock draft.
That is absolutely correct.
Which you can follow on the Caps profile, TMF Stock Draft 13.
It's not doing quite as well as we thought.
It's a long-term portfolio. It's a Berkowitz-type portfolio.
But I'm doing really well. I just got to point out that 4 of my 5 picks are beating the market right now.
I haven't even checked it.
It's been about, yes you have. Don't even try to lie.
Okay, that's a lie. I checked it. Yeah, I'm not doing great. I think I'm last.
You're checking it more than I am.
Long-term though.
We'll see. All right. Well, folks, that is the show for today. As always, you can follow us on Twitter. That's at TMF Financials. You can find us on Facebook. That's Motley Fool Financials. And if you're not listening currently on the podcast, you can find us on Stitcher or iTunes for the podcast version. I'm actually going to be out. And David, who's your first guest on the show tomorrow?
Simon Erickson from our Rule Breakers service here at the Motley
Simon Erickson will be here tomorrow. There's no reason to miss out on that. Again, I'm Matt Copenheffer here with David Hansen. Thanks for watching. We'll see you tomorrow.